Hello, everyone. My name is Victor Lai with Bellwether Capital Management, and welcome to part one of Learn About Bonds. This is a two-part series that provides some introductory information about bonds, what they are, how they work, and so forth. Bonds aren't the most exciting topic, but they are important. James Carville once said that if he dies, he wants to come back as the bond market so he could intimidate everyone. He said it as a joke, but there is some truth to his statement. Bonds can be intimidating because not everyone is familiar with the topic. We may only hear about bonds on the news when bankers and politicians are having serious discussions. So, yes, it's understandable why they can seem intimidating, but bonds are actually quite simple. And they certainly don't need to be intimidating. So my hope is after these two short videos, you'll understand the basics and feel comfortable enough to have a grown-up conversation about bonds at your next dinner party. In part one, we'll talk about what is a bond in the first place. What are the basic moving parts? Next, we'll look at why bonds are important and why we should even care. And then lastly, we'll go over some basic bond terminology. Bonds come with a lot of jargon, and bond talk can sound like a foreign language. That's part of what makes them intimidating. So we'll review some basic bond terms that we should understand. So, what is a bond? To start with, we should understand that there are many different types of bonds, and they can come with all kinds of special features. But what we will refer to in these videos is the most basic type of bond, which is just a fixed rate investment grade bond. This type of bond is like a loan, and as with any loan, there are two sides, a borrower and a lender. For bonds, borrowers are typically entities like governments or corporations. These entities borrow to do things like fund operations, to invest in growth, refinance debt, and so forth. One popular way for them to borrow is to issue bonds and then sell them for cash. So entities that issue these bonds, they're basically selling promissory notes or like IOU certificates almost. Now, whoever buys the bonds will become the lenders. Typically, buyers are investors, which can be other entities or individuals like you and I. Investors buy the bonds for a number of reasons, but one obvious reason is because they want to earn some kind of return on their money. That return comes in the form of interest payments, because just like with any loan, the borrower has to repay the amount that was borrowed plus some interest. And that's it. That's the basic breakdown of a bond. Now, a related question you might have is why don't the borrowers just get a loan from the bank like everyone else does? And that's a really good question. Borrowers would turn to bonds for a number of different reasons. First, sometimes a bank is just unwilling or unable to provide the loan. For example, back in 2013, Verizon had a huge bond offering. It was close to $50 billion. That's a lot of money, and frankly, that's maybe more money than a bank is willing or even able to lend to a single borrower in a single transaction. Another case, another example would be a company that's in poor financial health. This company may not qualify for a traditional bank loan. That company could try to sell a non-investment grade, also known as a high yield or junk bond, to investors who have the willingness and the risk appetite to fund that company and that bond for higher interest, of course. But the point is that sometimes the bond market is just the only practical choice. A second reason is that the bond market may offer more flexible terms to borrowers. For example, bonds are generally interest only for the borrower. That means the borrower only needs to make interest payments until the bond comes due. In contrast, the traditional bank might require both interest and principal payments, which would result in higher payments for the borrower. Another example would be a borrower that can explore maybe a special bond structure, something like a convertible bond. This would give bond investors an opportunity to participate in stock upside in the price appreciation, and it would at the same time give the borrower, the company, an opportunity to possibly eliminate the debt if the price rises high enough, stock price rises high enough. And so the point here is that bonds can provide both borrowers, in some case investors, with more flexible terms. The last point I'm going to mention about this is that borrowers may simply get a better deal from the bond market, especially when interest rates are low and investor appetite is very high. For example, Apple sold, back in 2013, Apple sold some 10-year bonds at a yield somewhere around 2.4%. That's a very low long-term rate for a corporate borrower. In fact, it's about the same as what the U.S. government, federal government, is paying on a 10-year Treasury note. And the point here is that interest rates can simply be lower in the bond market versus what banks are lending at. In the next slide, we're going to look at why bonds are important and why we should even care. The first thing that makes the bond market or bonds important is the sheer size of the bond market. Even though stocks are the more popular financial asset, the reality is the global bond market is larger than the stock market. That's shown on the chart you see on the right. One thing I want to point out is that the bond market is still larger today, even after the stock market has been on a huge decade-long rally. If we look back to 2009, the global stock market cap was only about 30 trillion. And at that time, the bond market cap was still over 80 trillion. So the difference back then was far more pronounced prior to this big upswing in stock prices. But over time, the bond market has been persistently larger. The bond market size and its depth make it arguably the most important financial market in the world, because all the money and the capital that flows through the bond markets help keep businesses, governments, and economies moving. So bonds are definitely very important from a macro perspective. But it's not just the big picture. The bond market actually affects our everyday lives. Everything from the interest rate on mortgage loans to the prices of goods at the store, even the number of jobs available. All of that can be influenced by what happens in the bond market. So bonds are not just interest rates floating around in the news. They have tangible, real-world effects, and that makes them important to understand and to pay attention to, in my opinion. Okay, so we're going to finish part one by reviewing some basic bond terminology to help make sense of all the jargon that exists in bond talk. The first term is bond issue or bond issuance, also known as bond offer or bond offering. I've used this term already, and it refers to the initial sale of a bond by a company to investors. This is the act of issuing a bond, which is a verb, but sometimes people will use issue as a noun. For example, the company can be referred to as the issuer. Sometimes the bond itself can be referred to as the bond issue or the offer, so it can get a little confusing. The next term is maturity, which is also known as a bond's term. A bond is typically issued with a predetermined term or amount of time that the bond will be outstanding. Just like a mortgage can have a 10-year or 20-year or 30-year term, bonds are also issued with predefined time periods. And when those years are up, then the bond matures, which means that it comes due and the principal must be repaid. Par value, also known as face value, refers to the initial price or principal value of a bond when it is issued. Bonds are typically issued with $1,000 face values, so one bond would equal $1,000, but that's not always the case. Bonds can be issued with different par values, but whatever the value is, it's important to distinguish the par value because the price of a bond can actually change over time. However, par value is what needs to be repaid at maturity, and that does not change. Coupon rate refers to the annual interest that annual interest rate that a bond is originally issued at. In other words, it's the original interest rate stated in terms of par value. So for example, if we have a $1,000 bond that's issued at 5%, then $1,000 the par value and 5% is the coupon rate. That means the bond will pay $50 per year in interest. That $50 payment, that is called the coupon payment. So up until this point, all these terms have been pretty straightforward because we've been using them to describe bonds at issuance. But something that can be a little confusing is that all of these things can change after issuance. So for example, a bond may be issued with a 10-year term, a 10-year maturity, but after 1 year, that bond now has a 9-year term. After 3 years, it has a 7-year term, and so forth. And it's not just the term that can change, but price can actually change as well. So premium refers to a bond price that is above its original face value. And a discount, that refers to a bond that is below its original face value. So after a bond is originally issued, it can be resold or rebought in the bond market. In other words, it becomes a publicly traded security. And like any publicly traded security, it will have a market price that fluctuates up and down. We will look at why prices fluctuate in part 2, but right now, just understand that market price can fluctuate away from face value. The last term we'll talk about is yield. And this term tends to be the most confusing. In simple terms, yield just refers to the annual interest rate in terms of price. The problem is that yield can be stated in a lot of different ways. We already talked about coupon rate, which is like the original yield. But after issuance, remember, the bond price can change, and when it does, the yield will also change. So for example, let's pretend again that we have a $1,000 bond with a 5% coupon rate. So our original yield is 5%, and the bond pays a $50 coupon payment every year. Now let's imagine the bond price changes, and it changes from $1,000 to $2,000. As a side note, that's not realistic. That's unlikely to happen, but I'm just using a simple example here. And if that did happen, the $50 coupon payment does not change, and neither does the 5% coupon rate. But the yield does change. In fact, the original 5% yield, that would fall in half because the $50 coupon payment divided by the new $2,000 market price, that becomes only 2.5%. So that 2.5% yield, that's what we call the current yield. So in other words, if we were to go ahead and sell our bond for $2,000, whoever buys it from us, that buyer will only get a 2.5% yield, even though the coupon rate is still 5%. And the reverse is true, of course, as well. So if the bond price, if it fell from $1,000 down to $500, then the current yield would go from 5% to 10%. Now, in addition to current yield, you could see a bunch of different terms. So you could see yield to maturity, yield to worst, option adjusted yield, SEC yield, distribution yield. There's just so many different variations of yield that it can get quite confusing. And the takeaway here is that it's very important to clearly understand what type of yield you're looking at, especially if you're going to be comparing different investments. Okay, so we went over a lot pretty quickly, so here's a quick summary. A bond is like a loan, where the borrower is the bond seller and the lender is the bond buyer. Governments and corporations all over the world sell bonds in exchange for cash, and investors will buy the bonds for a number of different reasons, one obvious reason being they want to earn some return on their money. Bonds in the bond market are very important to the global financial system as well as to our everyday lives. So it does make sense to understand them and to pay attention to them. And last of all, bond talk involves a lot of jargon and it can get confusing. So one good way to get comfortable with bonds is just to familiarize ourselves with bond terminology. Okay, so thank you for watching. I hope you enjoyed this video or at least found it informative. If you did, please like, subscribe, and share the content. You can visit our website to learn more about BCM, what we do, and how we can help, and also find more content. The links are going to be below in the description. Thanks again, and please stay tuned for some important additional info.